If you're paying PMI, you might be wasting money without even realizing it. Let me break it down really quick so you know what it is, when it goes away, and how you can get rid of it faster. So first, PMI stands for private mortgage insurance, and it's usually applied to your total monthly payment whenever you put less than 20% down on a conventional loan. And remember, it protects the lender, not you. And now here's the part most people don't realize. Your PMI can fall off after you hit 20% equity, but it doesn't automatically fall off until you hit 22% equity. And you can get there faster by making extra payments towards your loan, or most of the time your value just starts to raise and it can just fall off that way. The thing is though, that you have to notify your lender. They are gladly going to take your money until you either hit 22% equity or you notify them that you've hit that 20% mark. It's also important to keep in mind what loan type you had when you bought the property. If you bought with a conventional loan, that PMI will fall off after that 20 to 22%. If you were FHA, it's actually called MIP instead of PMI, and MIP stands for Mortgage Insurance Premium, not minor in possession. And with an FHA loan, it's usually going to stay with it for the life of the loan unless you refinance. VA loans are sweet because you don't have any premiums at all. And a USDA loan is sort of like an FHA where it's going to stay with it for the life of the loan unless you refinance it. The good news is that if you believe that your home has increased in value enough to have that 20% equity, usually you just need a new appraisal. And if the appraisal shows that the value is there and you have a conventional loan, you can usually just have PMI fall off. And if you've owned your home for a few years and you don't know where you stand and you're curious about this, I'm happy to run some numbers for you and see if it's even worth looking into. And I promise guys, no pressure, I'm just here to help.